Okay, let's get to it. This week we had we had Reverend Obama go to Washington. Now, the only smart thing that I think that he did do was he didn't show his face on Wall Street because you would have had some psycho Wall Street bankers going crazy on him. So I think he got some pretty good advice there. What I found most interesting in his speech, or in his sermon, as I should put it, was the fact that he came to us. He warned us 2 years ago about the risks that we were taking in the financial industry. And I said to myself, where was I? Because the only thing I remember the government doing over the past decade was allowing Freddie and Fannie Mac to underwrite the worst mortgages possible. You can go back, you can find blogs on the internet of me writing back as early as 2005 about what was going on in the mortgage markets. These banks were writing mortgages to people that weren't showing any documentation of income. They were buying multiple properties, and there was simply just no underwriting standards. Yes, was Wall Street involved? Absolutely. They're scum of the earth. I'm the first one to say it. But they're already being demonized. And what the government wants you to believe, it was all Wall Street and they had nothing to do with it, when nothing could be further from the truth. The government had the opportunity in the early days of the Bush administration, not that he was any saint by any stretch, but in the early days of the Bush administration, had the opportunity to rein in Freddie and Fannie. Who did you have it stopping any type of reform? Maxine Waters, Barney Frank, Christopher Dodd. All these thugs were in the tank for Franklin Raines, former cabinet member of the Clinton administration. And he was robbing the place blind. So it was all in an effort to get their constituents to have mortgages that they couldn't afford, get them into houses. And Bush is just as guilty as this. He allowed it to happen as well. I'm not taking sides here. But for Barack Obama to say that he tried to warn us is just a height of hypocrisy. It's an absolute joke. So I'll leave you with that. That's my commentary. I digress from the purpose why I'm here today, and that's to talk about the markets. Let's take a look at the Dow Industrials on a monthly basis. The Dow Industrials. Look at this. It's simply unbelievable. You had a beautiful bottoming tail on Thursday. Here's the monthly chart of the Dow Industrials. And it showed that we were going to head higher on Friday, which we did. Now, take a look at where we're at on the Dow Industrials on a monthly basis. We're at 1159.61, which runs exactly where its 50-week or 50-month moving averages. That's resistance. And you can find resistance at the same level going back to mid to late 2008. And that was during the collapse of the market. So, yeah, on this chart, are we having a V-shaped recovery? Absolutely. But if we roll over here, you draw a trend line, we're still in a downtrend. Okay? It would have to come all the way back up here to 14,198 for it not to be a downtrend. And it's not. We haven't gotten there yet. It's a long way to go. And to believe that we're going to head all the way back up here is a long shot. Believe me, I wouldn't have thought 3 months ago that we would have gotten this high where we are right now, but we have. So nothing's out of the realm of possibility when you have printing presses going off in Washington, D.C., fueling the drunken hysteria that's out there right now. It's like a drunk with a punch bowl in front of him. Unless you take that punch bowl away, the party's going to go on all night long. It's just the way it is. Let's take a look at the RTH, the retail holders. This is a daily chart of the RTH. You can see we had an inside day on Friday. We're at an RSI on an index. This is an index. And for those of you who use the RSI, you'll appreciate what I'm saying, that to have an index to go almost over 80, they consider, most people use 70 as overbought on the RSI. I don't. I use a minimum of 80 on the RSI to make any type of trade decisions on. And we're at 79.17. Good move higher. We'll go 80 in a heartbeat. So, as a matter of fact, we're probably above 80 on Thursday afternoon. So let's be careful here, folks. I mean, we're getting short of. We have a retailer that we're shorting right now, which even has a much higher RSI reading than what the index does, and we're going to be planning on adding to that short position. If you were going to join us in this trade, you can actually get short at a higher price than where we were able to get short. So the risk reward is in your favor. So if you're interested, sign up for the 14-day free trial offer, and you can get it. You can get that trade. Let's take a look at the 10-year bond. You'll remember a few weeks ago I was mentioning that the 4% mark is a psychological level for the markets, and we were right around there a couple of weeks ago, at the beginning of April, and then we had that bond auction, and the whole market, CNBC, really hyped it up to be a bad bond auction. It's going to be a bad bond auction, and the rates followed. They were listening. The bond traders, they were afraid, and they predicted that bonds were going to have a bad auction on the 10-year, and the rates were going to spike right through 4%. Now, I wouldn't have been surprised in the least if we did have a bad bond auction, but considering the fact that Greece wasn't resolved yet and that there were a bunch of other European countries that were in trouble, it didn't surprise me when that auction did go well and the money wanted to find a safe haven. And so it found its way to the United States. And we had a good bond auction. Yields sold off. We're still below this 385 level, which is resistance. I'm betting, since we have this double bottom here, we're going to break through it again, and we can go above 4%. They may want you to believe that the market can't go higher above 4%. That's not true. We can still go higher on the market, so long as that spike in rates is not a spike. It's just a rise. It's an incremental rise. We can go as high as 5% without the market really getting shaky, so long as it's done in increments. So don't base your trade decisions solely upon the yield on the 10-year bond. Just be aware of it and how rapid it's rising. If it rises fast, look out below on the stock market. Okay. Let's take a look at the VIX. I had the VIX up here a while ago. Here it is. All right, we had two solid days, Thursday and Friday, solid days on the S&P 500 on the stock market as a whole. Now, what we have here, two neutral days, especially on Friday. You had a reversal on Thursday, and it was pretty much a neutral day. And then you had this also a reversal on Friday, which is more of a bullish sign to me because we opened lower. I'm sorry, we went lower, not at the open, but we closed at the open and the high of the day. So what that tells me is that you have some put buyers in here that are hedging their positions, even though this market's heading higher. Now you can take a look at the S&P 500. 1200 we went through like a hot knife through butter. We just went right above it. It was no sweat, which I was surprised at. But here we have the declining 200-week moving average at the 1224.58 level. That I'm going to predict is going to be our resistance level in the short term anyway. Can we go higher? Absolutely. But just take a look at the RSI. We're above 70 on the S&P 500 on a weekly basis. That's huge. That's a very overbought market. So it's not going to take much for this market to go tumbling. So please, I beg of you, if you have decent profits to the long side, start taking some of those profits off the table because markets don't go straight up all the time. You want to take your profits when everything looks great. And right now it does look great. We opened up positions to hedge against inflation as we saw this 10-year bond come in. I didn't want to get long of anything else because everything is so overpriced right now. But I opened up as the bond came in, so did our inflation hedges, which we decided to go with in some commodity names. And if you want to know what those are, sign up for the 14-day free trial offer. You'll find out. So we bought on this pullback. We went long. Our long positions now consist of inflation hedges, things you want to own when rates do go precipitously higher. And it may not happen in 2010, folks. 2011, 2012, 2014, when this healthcare bill hits. Trust me, rates are going higher. The printing presses are not stopping. So please, be careful. and buy wisely, take profits. If you're going to get long new positions, get exposed to things that have inflation hedges, that are hedges against future rates in interest rates. Because the rumor is on the street, rates are going higher sooner than we expect. And that's from the Fed. Not just what the bond market's going to predict, it's from the Fed. So be careful. Once that starts happening, there's no reversing it. Once the Fed starts to raise, it's a cycle. It doesn't just happen one time. It's not like an emergency rate cut that can only happen once. It's going to happen continuously until they make sure that any inflation they see is stomped out. So please, if you're interested, please sign up for the 14-day free trial offer. If you don't like it, cancel out through PayPal. I don't have your credit card number. Don't want it. Use your PayPal account. That's why I use them. Great company. Sign up for my YouTube channel and have a great trading week, folks. Have a great day. Enjoy this weekend. It's beautiful out. Thank you. Bye-bye.